Click here to subscribe for free to ReluctantPreppers.com. Hey everyone, this is Elijah Johnson with FinanceAndLiberty.com, and back with us today is silver expert David Morgan. David, thank you so much for joining us today.
My pleasure, Elijah. Thank you.
So I first wanted to discuss about what is happening with the silver market right now. Today's Tuesday, September 30th, and we're actually seeing silver right now below $17. It's just below $17. What do you make of what's happening in the silver markets? It seems like it's getting smashed.
Well, it is getting smashed. There's no ifs. The support level is about $17.50, and obviously, as you said, we're under that intraday trading off another 50 cents. It was actually holding that level for a few days, but it's broken that. So it's really difficult to say, other than there's a lot more selling than buying. Obviously, on the futures markets, they have to match, but the reason the price drops is that there's a lot of sales, and they have to match, and so people aren't willing to take the other side until the price goes lower. And once it's lower, then the orders get matched. So there's selling pressure in both the markets, gold and silver, actually platinum and palladium as well. If you look back to palladium, has been the star performer of the four metals in the last several months, reaching over $900 recently. It's under $800 right now. So all these metals are getting hit pretty hard. There's all kinds of reasons that are given by the mainstream press, predominantly the U.S. dollar strength. But and that's true. I mean, the U.S. dollar on the dollar index has gone up rather significantly for the last few months. But I think it's a little deeper than that. I think that there's a lot going on behind the scenes. If you look at what Coase has done with the reports that he does, he has indicated how much physical silver has been taken off the Hong Kong exchanges into the Chinese market. And the Chinese market is pretty vast for physical gold and silver for that matter. So it's really difficult to get a handle on exactly what's going on. We certainly know that the derivatives markets is pervasive throughout all the financial markets, predominantly in the interest rate sector, more than any place else by far. It's the debt markets that carry the biggest amount of financial burden, well beyond what the gold and silver markets entail. So there's a lot happening behind the scenes, and fundamentally things really haven't changed that much from the 2008 crisis. Certainly we have gotten through that in a manner that has given, I would think, a false belief to a lot of people that it's behind us and things are better. They certainly seem better and appear better, and for maybe even practical purposes are better, but the problems have not really been addressed. In fact, they're getting worse as far as the amount of debt load and the amount of derivatives are back up. And there's less banks to carry the burden, so we've gotten fewer points of failure that could rile the system again. So on the big picture, Elijah, my perspective is that this is a more of an illusion about how strong and good the economy is, about how strong the U.S. dollar is, and how wonderful things are, rather than giving a clear, explicit picture of the actual facts that we are really having to live with in the debt markets, the precious metals markets, the stock markets, and the overall economy. I want to go on just a moment to say that I want to not, give the impression too much of a gloom and doomer. I try to be a realist. Certainly there are areas in the economy that are always doing fairly well. I mean, the entrepreneurial spirit of the United States and other areas, new inventions, new ways of doing things. This 3D printing is pretty popular. It looks like it's got a long ways to go. There are better methods throughout the technological sector. I mean, if you look at, what the original cell phone was like compared to what a smartphone does today. So that isn't to say that there are not bright spots in the economy and that certain areas are doing better. But on balance, the big picture again is that the overall American, really in real terms, in real wages, hasn't done much since basically the mid-70s. Their real purchasing power has gone down, even though the amount of quote-unquote money has gone up. So again, there are bright spots, but the bright spots that I see are not significant enough to cause what I would consider to be a substantial boom in the economy. In other words, there's not enough innovation or whatever, at least at this point in time, that I see, because the debt burden is so big. That's the main problem, obviously.
Right, and getting back to what you were talking about, the derivative market, I know in a recent interview with Butler on Business, you said that the paper commodity markets have become, quote, big speculative casinos, and that the cover ratio in all commodities is greater than the physical reality. But for silver, as far as a coverage ratio goes, it's extraordinarily high. Did you want to discuss a little bit about how this impacts the silver price?
Sure. In fact, if we go back in time, turn the clock back maybe a decade or so, when I was doing a regular show with Jim Popala on Financial Sense News Hour, he actually asked me to write about the manipulation, and it's still on the website. I think it's probably archived in my archive file on my website. But what I said, and it still holds true, is for a very long time the market doesn't care if you're being supplied paper silver or real silver. Now, let me explain that, because obviously a manufacturer that makes real silver isn't going to take a paper promise. So the underlying part of that is that as long as there's enough physical to go around, the market doesn't care how the supply is met. So most of these futures contracts and derivatives contracts are settled in cash. In fact, most of them have only one purpose, and that is to settle in cash. Very few people actually are in the derivatives markets to obtain physical commodities. And that's true across the board, meaning it's true in the corn market, it's true in the soybean market, it's true in the oil market, it's true in all these markets that are on the futures exchanges. Most of the physical commodities that we're familiar with are sold in the forwards markets, which are over-the-counter markets that aren't transparent to the public. And these operate similar to futures contracts, but yet they, again, are not accounted for anywhere with any regulation. And so these type of contracts, which are done by individuals, groups, entities that basically specialize in that, will make contracts in these commodities, and that's where it basically gets sold. For a quick example, in the silver market, some of the largest producers are base metal mines, and they have contracts either directly with the silver user, probably through the Silver Users Association, or indirectly through a bullion bank that supplies somebody that's a member of the Silver Users Association. So they may additionally, in fact in most cases do additionally go into the futures market to quote unquote hedge. But that's only a paper product, and they know that full well. The physical supply has already been negotiated, and the contract is there for delivery to whomever they have done this deal with. So a lot of that is what really takes place in the market, and I had a misperception when I was much, much younger that, almost all these commodities flowed through the exchanges, and so that you could get a pretty good idea of what was going on in the wheat market if you watched, what the inventory of wheat was and the farm reports and all this stuff. Not saying that some of that doesn't have merit, but what I'm suggesting is that all these commodities have such a huge cover ratio, and some much greater than others, silver being exceptionally high. Well, some commodities have cover ratio, 30 days or, 40 days or that type of thing, where silver is several months. And this is unusual, but what it shows is the amount of paper to physical is much greater in silver than probably any other market, at least in the transparent markets. We can't really state that in the over-the-counter markets, other than you'll get information that's kind of leaked out once in a while. Bloomberg put out something about the $5 trillion silver market versus the $14 trillion gold market. Now, where they got those numbers, I don't know, but it was a pretty reliable source. Bloomberg would suggest that on a paper basis, there's basically 1/3 the volume of silver that there is gold, yet the ratio is like at 70 to 1. So, again, I just want to emphasize the point. For whatever reason, silver has a huge cover ratio relative to any other commodity that's traded, be it, the agricultural commodities, the softs, anything else. Probably the only other commodities, if you want to call them that, are quote-unquote money, which I mean debt. And the trading in debt, of course, is huge relative to any other market. And what the ratios are, it'd be hard to say, but I wouldn't be surprised to see that it's even greater than what's in the silver market, meaning that there's so many swaps and derivatives upon derivatives that are out there based on interest rates that it probably does dwarf the silver market, but it's very difficult to get a handle on that as far as what the amount is other than the notional value, which is a much bigger number than the actual true number that it represents because the leverage is so great.
So how do you think this is impacting the silver price right now? I mean, do you see that this is a significant reason why we're seeing a decline in the silver price?
It is. I think that it's going to take whatever it takes. I mean, I would love to have, definitive answers. It's going to stop on this, point in time at this price because of this reason. But I don't have that. What I do know is that we're under the cost of production for a primary silver mine substantially. I know that all bottoms, eventually take hold. I was thinking that September would probably be the worst month. We've got another day in September. I felt that in October we'd probably get a turnaround of some type. That may be true, may not. There's a lot of words on the internet from analysts that are fairly respected, especially from the banking perspective, that are looking for $14 silver. I don't see it going that low, but I'm not going to say it won't or it can't. Silver can surprise just about anyone, including yours truly. What I do know is that fundamentally it's at a very opportune buying point, because if a primary silver producer produces it at $22 or $23 an ounce total all-in costs, and it's at 17, you're doing much better than a primary silver producer is doing if you buy it and hold it. And those type of situations, commodities usually don't last a very long time. In other words, they usually don't last, month upon month upon month. If they do start to drag on, then what happens in any business, silver being no different than many other businesses, they're there for a profit. And if they become extremely unprofitable, the business decision is made to either stop, curtail, put on hold, or some way or manner to cease the activity or drop it down into a very minimal state. And that, of course, puts supply pressure upon the market because there's less supply. And with less supply, generally speaking, you're going to see prices rise. So I think the market is not accurate in its pricing at all times. I mean, if it were, there would be no point in trading these markets or investing or anything else. So, as Warren Buffett says, and I'm not a huge fan of Mr. Buffett, but as he says, Mr. Market makes mistakes from time to time, and an investor should take advantage of that. Now, did I foresee silver dropping to this level? And the answer is no. I thought that the 1817 low would hold, didn't. Once it got under 19, I put out an alert to my members saying, I'm certain that the 1817 level will be tested, and of course it was. And obviously, we're below that now, so it's difficult. I mean, I don't know, I don't want to mix my words. I want to be clear. It's difficult. It's a bit surprising. Also, the fact that the 1750 level has been broken. We'll see if we get a close above that today, but it certainly doesn't look that way. It certainly looks like it's going to trade at the 17 level for quite some time. And if it closes on the low, which it looks like it may, then that's bearish. Anytime a commodity, I don't care which commodity it is, closes on the low of the day and drops significantly and trades at that low level the whole day, you're almost assured that the next day it'll drop even further, maybe not as substantially, but it's bearish when you close on the low. Conversely, if you close on a high, it's bullish. But we haven't had much cheering to do, Elijah, in the precious metals markets for some time, other than, as I mentioned, the palladium market, which was leading the sector up until very recently. It seems that once that it made a new high in such a thin market, very few people pay any attention to it at all. But once it had made a new high, it seemed as if that was a threat almost. And from that point to making that $900 print, it's been down, down, and down for palladium as well as the other metals.
Definitely. And while we're seeing the precious metals under pressure, we're also seeing the dollar strengthening. You recently wrote an article titled, "The US dollar is the last stop before the gold and silver spike," in which you said that the run to the dollar is a precursor that is absolutely necessary before the run to precious metals. Did you want to talk a little bit about this?
Sure. It's an article that I actually from a couple of interviews. I did an interview with Butler on Business that I do every Monday, and then I was on the Greg Hunter Show, USA Watchdog, and I talked about something I'd written before, which is the Exter Pyramid. John Exter, for those that aren't familiar, you can Google him and get more information, but he was president of the Federal Reserve Bank in New York, pretty much known as a gold bug, and he had what was called the upside down pyramid, which shows the financial markets and how they actually operate. And it's a very good analogy of how the system is, because if you picture an upside down pyramid, the pyramid continues to expand at the top, and that's exactly the way the system is set up. In order to have continual growth, which is how the system is mandated, it has to grow. The money supply has to grow. Then you continually get a bigger and bigger base. And of course the interest isn't made, so the interest has to come in some other form later in time. And of course the debt just keeps compounding. So what John did was he took this upside down pyramid, explaining that the debt always increased and that there was different categories of financial instruments, some being more safer than others, some being having more confidence than others. So for example, the derivatives have a very low confidence, and we saw that in the financial crisis of 2008. Basically what happened was there was a total loss of confidence in these mortgage-backed securities, and that banks didn't trust each other. So that sector, or that part of the pyramid, which was vast, started to unravel, and of course the Federal Reserve came in and saved the day. But then, so underneath the derivatives, there's other instruments, other debt instruments that are not as, let's say, toxic as those. And then you come down to pyramid. Well, as you come down to pyramid, you get into safer and safer investments that are held by investors and felt to be much more, have much more confidence. So the most confident sector that you can have outside of the precious metals is a physical note, a Federal Reserve note, a Euro note, an Aussie note, a Canadian dollar, whatever. And that is at the very next to the tip of the pyramid. And so, for safety purposes, as an example, if someone had money in the bank and they were worried about a bank failure or a bank run or whatever, and they actually took their money out of the bank physically and had it in cash, and had it under their mattress as a metaphor, they would feel extremely safe. If something happened to the bank or something happened in the financial markets or whatever, they're in pure cash. So that is the step that probably 99% of people that are concerned about the markets would take if they felt the situation demanded. In other words, they were very fearful of the financial future or the banking system or financial system or whatever. So that's a rare event. And of course, before that, what you have is you have a run to as good as cash, which really means a run to the dollar or the euro or whatever, primarily the dollar because of its status as the backing the oil markets. And so you're getting out of stocks, getting out of bonds, getting out of some derivative instruments, and moving into cash. And that's very easy to see, and supply and demand applies, and so there's a more demand for cash and less demand for these other instruments, and that means that the dollar's got pressure to go up, and it is. But if you look at the pyramid, that is a step before there's a run to gold. So what causes the run to gold, of course, is that final confidence factor that everyone is, not everyone, but many, many people are voting and saying that, the dollar is the best place I can be. It's the safest place I can be. I have the most confidence of anything I could do as I own the dollar. And that confidence shifts for whatever reason. And there are many reasons out there that it could. And once that is lost, then begins the run to gold. And that's something that even the Federal Reserve can't really control. I mean, they certainly can control a great deal, and I admit that, but they cannot control the overall psychology of the market. And once there is a shift to the thinking that even this currency is something that I don't have confidence in, then there'll be a big run to gold. So is it imminent? No. I mean, look at the prices, look at what's going on in the markets, but I wouldn't focus too much on the price. I don't need a lot of emails telling me what am I saying. Of course, price is important, and that's how everyone measures things. But really, if you think about it, price is what varies, and the metal itself doesn't. I mean, an ounce is an ounce no matter what. That hasn't changed, and the number of ounces you have is really something to focus on, probably more than the price at times. At least I think about it in those terms. So it's a step down the pyramid. It's a step to safety. So what you might say, Elijah, is that what it could indicate is that the stock market may not be just the juicy, wonderful, fantastic place to be anymore, and some of the smart money is moving out of that market and into the safer investment, which would be currency and primarily U.S. dollars. So as part of the process is the way I look at it. I look at it as if, these things happen, they have to happen. It's the way the system is set up. And as odd as it sounds that there has to be a run to the dollar before there's a run to gold. But remember, the dollar is extremely liquid, and so is gold. So it's a lot easier to move from, cash into gold than it is to move from a stock into gold, because you got to go from the stock into cash first and then from cash into gold. Well, if you eliminate that step and you're in all cash, or you have a great deal of cash or whatever, then the next step is pretty much automatic. So again, as part of the process, take a look. I do find other articles on the extra pyramid. Trace Mayer of runtogold.com did an excellent job of really updating the pyramid. I put that in my article so people can see it. You can study this stuff, get an opinion formed by yourself, look at it, think about it, question it. But the dollar's been king, for a very, very long time. And you look at these currency failures that have happened around the planet. You look at, Zimbabwe, Argentina. You look at even the ruble at times, years ago, the Asian currency crisis that I'm old enough to have gone through. You might probably were too young, but most of these places where they have a currency crisis run to the dollar. I mean, the dollar is what everyone believes in. And again, they believe in it until they stop believing in it. And it isn't a universal thing. It isn't like 100% of the population stops believing in the dollar. It doesn't work like that at all. It's a very subtle, small shift at first. But then the markets take hold and realize that somebody wants out of the dollar in a big way, or somebody is offing dollars, in other words, selling dollars. And selling for what? And if the gold market starts to rise substantially while the dollar is starting to crater, then since the dollar market is so large and the gold market is so small, you'll see, you can see a huge shift. And I've lived through that already. I mean, I went and saw, lived through the bull market of the 1970s, and I watched, silver go from $6 in January of 1979 to over 50 in January of 1980. So in a 1-year time frame, I saw commodity go up over 800%. And gold, I was actually in the futures market, and I had, gold contracts at 300. In December, I bought them like in September, and they were like December gold. And, those contract gold went to like 875 in the futures market, 850 on the spot month. So there was a time when I was watching, these two gold and silver markets just keep going up and up and up and up. And it was basically a buying panic. I mean, the main worry in those days was huge inflation and that the dollar was toast. And once Volcker came in and threw interest rates sky high, it quelled the markets and basically started a 20-year bear market. But the confidence factor in the dollar, I think, is misplaced. There's never been a fiat currency in the history of mankind that hasn't failed. And the fact is the Federal Reserve Board itself admits that the U.S. dollar from the inception of the Fed in 1913 to 101 years later today is worth roughly 4 or 5 cents. So that's about a 95% failure. And yet we're worrying about what this last nickel's worth of dollar is going to do. And I'm not saying that the dollar doesn't have value, it doesn't buy you something. But just in my lifetime, I look at, the price of gas or price of a home or price of an automobile. I mean, the price of an automobile today is what my father paid for a great middle-class house when I was in high school. So, the inflation is an insidious thing. And if it's slow enough, and it has been, then the confidence remains in the currency. But that doesn't mean it's going to remain forever. So I'm very long-winded, I think, on all of your questions. But I'm a deep thinker, and I'm not trying to be right. I'm trying to give a historical foundation and experience to let people that are in the sector know that it should be fine. I think we're going to have our day. And one thing I want to emphasize, Elijah, is that I try to balance not only my portfolio but my life at large, and that anyone that understands how much, let's say, management or control is in these markets realizes that you can have a position that certainly could go against you for quite some time and still be right. The problem with some people is that they get the impression that the only place to be is in perhaps the precious metals markets. And I certainly hope I've never given that impression. I certainly think it's extremely important. I think everyone should own precious metals. I truly believe that. But you don't have to own it in such size where it damages your well-being. If you can't sleep at night because you bought too much silver or bought too much gold or both, then you haven't balanced your situation. And people ask me, well, what else should you buy? And of course, I specialize in metals, and that's really what I devote almost all of my time to. But as I said earlier, there are other asset classes. Several of the commodities are good, oil especially, although that's hard to invest in. In the futures market, I wouldn't recommend for anybody other outside of the professional. But there's stocks, etc. So there are ways to balance a portfolio. I'm not going to give you that information because I'm not that's not really part of my expertise. But I do want to point out that 10 or 20% holding of metals is probably plenty for almost anybody.
For those who are interested in getting involved in the metals markets right now, I know you discussed on your interview with David Smith about the risk-reward ratio right now in the precious metals markets. Did you want to talk a little bit about that?
Sure. There was a book, in fact, one of my futures brokers owns it, and they have it in my library downstairs, but it was a very fascinating title. It was titled, "You Can't Lose Trading Commodities." And of course, almost 97% of the people that ever enter the futures market end up losing and leaving. So what a title, "You Can't Lose Trading Commodities." So I bought the book and read it. And the premise of this book made a lot of sense. Basically, the premise is that if you could buy a commodity, doesn't matter which one, corn, wheat, ag, softs, metals, whatever, and you can buy it under the cost of production. You can buy it under what the farmer could grow it for. And you can hold on, and he's talking about contracts, not necessarily physical, but that's the beauty of the metals markets, is you can buy it in the physical form and hold it. Whereas buying wheat in the physical form can be done, but where do you store it? So if you can buy it under the cost of production and have patience, you are going to make money. That's the basic premise. And I adhere to that. I think that that's valid. So the risk reward in silver and gold, both are basically under the cost of production for primary gold and silver producers. So the risk reward profile is extremely favorable to those that, one, can buy for cash, two, store it, and it's not hard to store, gold especially, but silver really isn't as bulky as most people think as far as, the amount of space it takes relative to another commodity like wheat or soybeans or anything else. Basically, it's very bulky relative to gold, but, you can put gold coins in your pocket that will buy, pretty good size, a nice automobile in your two front pockets, and walk in and, pay for it in gold, and really, no one's the wiser. In other words, it's a very small volume relative to the amount of value, even at $1,200 an ounce gold. So the point is that is a very, very favorable risk to reward profile, and the hardest job, I think, still lies ahead. And that is when these markets do bottom and they start back up, when we finally get, 3 years from now or whatever, and these markets are going higher and higher, and there's more and more momentum, and people are extolling the beauty of owning precious metals again, and, how bad the dollar is, and all that type of thing that we saw, once before in the, basically after the 2008 crisis, when gold and silver both were, went out with the bathwater and bottomed, and they had a spike low and started back up, running into April 2011 for silver and September 2011 for gold. Because I believe strongly you'll see those days again. But right now, of course, it's the other extreme. The sentiment's very low, but the profile, as far as a savvy investor, Mr. Market's making a big mistake. And if you have the wherewithal to add to your position, if you're so inclined, or start a position, certainly now is probably one of the best times. Does that mean that I'm saying that silver's not going lower? No. I mean, the smart way to do it really is probably to buy it over the next 3 months or so. I don't think this low is going to be here a very long time. I mean, we've been bottoming for the last 3 years in silver, and usually the type of run that we had from $19 all the way up to 48, when you get that kind of extreme parabolic move on the upside, usually takes 2 to 3 years to digest that kind of a move. And we're certainly there. We certainly have had enough time to digest that big move on the way, on the upside. A lot of the stale bulls that bought at 30 or 35 or 28 or whatever, that have given up on the silver market, have sold their silver back in the market. So only the strongest of strong hands own it right now. And there may be new buyers. Certainly it looks as if the Chinese have an insatiable appetite for the metals, that no matter what the price is, they just continue to buy.
So you've mentioned that once people lose confidence in the dollar, there will be a run to the precious metal markets. But in the meantime, while we're seeing the dollar strengthening, do you think it would be a good idea to possibly invest in the dollar to try to ride the wave, or would that not be a prudent decision, maybe considering that the risk-reward ratio might not be that good?
Well, I haven't really been asked that question a long time, but, put on my, thought experiment hat, and I've thought about this a great deal. I mean, if you really didn't know which way the economy is going to go, because there are deflationary forces and inflationary forces, and they are occurring at the same time, regardless. And being an Austrian, I'm not supposed to say that, but I will. And so if you really didn't know, I mean, the smartest place to be would be 50-50. And I'm just going to eliminate silver from the equation. You have, 50% of your assets in gold and 50% of your assets in cash. And, if the Robert Prechter scenario was right, you would be very, very happy, because your paper assets would continue to appreciate in purchasing power, and your gold assets would probably not have as much value in paper terms. Conversely, if that scenario didn't play out, and the one that I'm more inclined to see play out in the future does, then you'd have 50% in gold, and your paper cash asset would be going down, but at the same time your gold price would be going up in value or in purchasing power. So that's a very, very simplistic way to look at it, but it's a good thought experiment for those that are concerned about, a deflation/inflation scenario. Which way do I play it? Well, you can play both sides, and that would be the way to do it. There's a lot made, and I'm probably one of them, that cash is trash and all that. But let's face it, it is important. It's important to have liquidity. As liquid as gold is, cash is more liquid, really, in today's world, because you're not going to be able to make a transaction in gold very easily, in an everyday market. You're going to use, some currency of some type, depending on where you are in the globe, where you're located. So that's really important. And a lot of people think that you should be fully invested, but I learned, from about your age, Elijah, on, maybe even younger, that it's very good to have liquidity, some cash, no matter how good an investment looks, and you think you're buying a low, it can go lower. Cash is sort of the way that we keep score. Even if you're a gold investor, most people don't keep score on how many ounces they own, although, again, from my perspective, that's a good way to look at it, because it sort of eliminates the price pressure. But the way they look at it is, what is it worth? Is it worth $1,200 or $1,300? If it's worth $1,300, I feel better buying it at $1,200. But and I'm not trying to invalidate that. What I'm suggesting is that that's how we keep score. What's our cash position? What's our net worth? Everyone figures what their net worth is and how many dollars or Canadian dollars or euros or whatever currency is their currency of their location determines how they feel about what their net worth is. But we got to look at the real wealth and the real economy versus the financial markets. The financial markets are so distorted relative to what the physical underlying economic system is that there's a huge distortion. And that's the problem, and it's getting worse, and that goes back to the upside-down pyramid. You have a system that continually has to expand exponentially, whereas the economy itself is not doing that. In fact, you can make an argument that in some sectors it's actually contracting, not growing. So the physical economy could be contracting at the same time. The financial system has to expand, and at some point that recognition of that problem is going to manifest. And again, when it does manifest, people are going to go to whatever they feel is more important than whatever asset class they hold. And the asset class that they hold that has the most risk are the ones that are going to dump the fastest, and those are the ones that will drop the most. And since the biggest pool of assets are basically in the most toxic waste imaginable, which is the derivatives market, once that starts to unravel, there'll be a move down the pyramid that will be quite substantial.
Hey everyone, thanks for watching. That's it for part 2. Make sure to click here to subscribe so you will be notified.
And since the biggest pool of assets are basically in the most toxic waste imaginable, which is the derivatives market, once that starts to unravel, there'll be a move down the pyramid that will be quite substantial. And again, I would urge you to look at my articles, kind of a briefing on it. If you want to get more in depth, you can type the Extra Pyramid into a good search engine. I'm sure there's plenty of articles out there that probably do a better job. Again, I direct you to Run the Gold by Trace Mayer. He did a great job of talking about it himself. I haven't read his article in a while, but he actually, in fact, I think he has a booklet about it, if I remember correctly. So, apologize a little bit for being long-winded, but again, I'm a deep thinker, and I like to think these things through, and I like to explain them well. I don't like to leave people, wondering why. I like to try to fill in as many of the blanks as I possibly can. And, of course, being a little older than, a lot of my peers now, and living through one market, I try not to get too low when these markets are low or too high when these markets are high, because I've been there at a younger age, and it's very emotional. I try to keep my emotions in check. I mean, am I upset that silver is at 17? And the answer is no. I'm really not upset. I don't like it. It's irritating, but I'm certainly not emotionally involved like I would be in the last market, where I just lived and died almost with every move up and down this time. No, I'm writing it out. It's an opportunity, as we talked about. If you have the cash to get in, buy for cash here. I think you're going to do quite well looking out a few years.
And for those who might be thinking that, maybe the precious metal bull market is over, you've talked about that it really isn't likely that the precious metal bull market is over because there hasn't been a public blow-off top, as you said. Did you want to talk about that?
Sure. There's, I've been involved in financial markets for a very long time. And when I was about your age, I was in the Los Angeles area. I think it was KHY TV. It was a TV channel that wasn't one of the main ones. And back in those days, there were only 20 stations or 15 even in Los Angeles, believe it or not. And this was a financial channel. In fact, this is where I got acquainted with Frank Barbera. For those that know the name, Frank and I have been friends for years, and very good intellect. I really like Frank and his thinking. And there were all kinds of ads for financial products. So one of the ones that was really interesting is a guy that, and I forget his name, I want to give him credit, but I can't recall. But he talked about the three phases of a market, and there's basically three up legs and two down legs. And this goes right back to the Elliott wave theory. I'm not a big Elliott guy, but I do understand the basics of it. And, depending on how you look at the chart, and I know there's a lot of people that hate charts, but, I'm a believer that it has use. We've only had a couple phases, and we haven't had the big manic phase. I mean, if the gold bull market did run its course, it was a pretty weak run because there was so little behind it relative to one, public participation, news media coverage, relative to the problems that are global. I mean, what I like to do is compare the fundamentals first. The fundamentals are that in the 1980 market, there was a little bit of pressure on the oil markets, and there was an inflation problem in the United States, and gold shot up substantially, and silver did even better, and it was all based on the M1 money supply. How much printing was going on. These days, everyone pretty much ignores that, and they're diverted into other markets. And there are a lot more markets to invest in now than there were back then. I mean, they've diluted it. They, meaning the financial system, has diluted the ability for money to go into gold, because it's like going to a county fair and there may be, 6 rides that you can spend your money on, but now you go in there and there's 600 rides that you can spend your money on, because you have all these derivative products, these ETF products, and all kinds of things, not to mention that the amount of stocks are greater, but primarily there's a lot of these derivative products that, are vying for your quote-unquote investment dollars. But coming back on point, the big move up usually ends with an unbelievable amount of mainstream press coverage, with the public really jumping in. And the public pretty much has shied away from the precious metals for the most part all the way up. I mean, you got to remember, gold was up, I think, 12 years in a row. It was only the 12th or 13th year where it fell off, which was 2013. But between roughly 2000 and 2012, if you were in the gold market, you made money every year, year over year. That's a pretty good track record. And then it was off 1 year, and everyone was kind of, down in the mouth and unhappy, and, thought, well, it's going to, restart. And, of course, 2014 thus far has been pretty detrimental to gold, and, of course, silver as well, much more so in percentage terms. And so now some of those people that may have gotten in early, like in 2000, 2003, 2005, 2007, whatever, and are looking at gold now, or thinking, this is it. Bull market's function is to shake off as many bulls as possible, and certainly this one has shaken off very, very many people that were gold and silver believers. So once the last are shaken off, and this is more of a metaphor than a reality, although there is some real merit to what I'm saying, then we can start back up. And people won't believe that this third leg is happening until it happens. What kind of a crazy statement is that? And that means that you won't really see believers, people that really follow these markets, think that anything's really going on until gold makes it into the 2,000 level, takes out the $1,900 level. And once that happens, you will see the momentum players come in. You'll see these fund managers come back in. You'll see these ETF players. In fact, they'll probably start resurrecting different ETFs that have more leverage to gold than ones that are out there right now. Who knows? I'm just talking thoughtfully, but sort of off the top of my head. But that's what it'll take. And how long it'll take to get there from here, I don't know. What I do know is that once the momentum starts, it starts to build on itself. We've already seen that in the silver market and the gold market, primarily in the silver market. I mean, when silver made the breakout from 19, I actually had that on my website for our members and said, I'm going long at the break if it breaks above 19, and it did. And it went to 26, it started to flutter around, and I got out. And a $7 move per contract is a pretty nice payday. And then I noticed it was breaking up to 26, so I got back in, and that was on the QE2 announcement. And silver ran from 26 up to 48. And then we had QE3 and 4 and everything else, and people said, why did silver do what it did? The answer is that nothing performs better in an inflationary environment than silver. And the anticipation of the announcement of QE2 is there would be all this inflation in the system. And it didn't happen. All the inflation went into liquefying the bank's balance sheet. It didn't go out into the public to be spent at all, basically. And so that money is basically dead money. I mean, it's just sitting as a metaphor, it's sitting in the vault collecting dust. It's not doing anything other than making the bank happy because their cash balance sheet looks a lot better because when they were negative and didn't have cash to cover, they were insolvent and they got this big injection. So that was a big market lesson for everyone that, the inflation could be there, and it is. I mean, as an Austrian, an increase in the money supply by definition is inflationary. But yet the inflation itself didn't go to where people could see it. So for the public this time to get into that panic, manic buying phase that we're talking about, it won't be because wages are, moving up like it was in the 70s or everyone sees inflation. It'll be more of a loss of confidence. And in a way, it'll be much more damaging than it was in the late 70s, early 1980, because at that time, there still was the ability to bring interest rates up, just completely clobber inflationary expectations, and move back to the dollar system and have it go forward. This time, the loss of confidence will be global. It probably won't be within the United States, and it probably won't be due to inflationary pressure. It'll be due to the debt markets and derivatives markets having a problem for settlement. Or perhaps it could happen after the BRICS continue on their path to circumvent the dollar or extricate themselves from the dollar or the dollar trading system and have their own clearing systems in. But whatever it is, it'll be because people want out of the dollar. And it won't be, again, as for emphasis, it won't be just the U.S., it won't be the population of the United States of America saying, they'll be part of it. But it could start anywhere in the world. And I think Jim Rickards probably does as good a job as anyone talking about, the death of money in the currency wars, because that's what it is. And that's how it's going to manifest. It's not going to manifest, I think, at the public level. The public will be the last. Once some of the bigger banks, bigger entities start to move out of the dollar in size and basically give up on it and move into something else, the tail will be the public, and they'll be running to do whatever they can to protect themselves. So it's not a pretty picture, but you have to look at the fundamentals. It's fundamentally impossible for the financial markets or the currency markets to continue to grow when the underlying physical economy doesn't match that. And that's the problem. The amount of debt relative to the physical economy, because they're basically supposed to match. The financial markets really are supposed to be reflective of what the true physical economy is. And price discovery is also supposed to be reflective of what the true price structure is. The price discovery method isn't supposed to be a discovery of how many derivatives have been written against a certain commodity and discover what the price of that derivative is. but that's what the market is. So that's what I mean by a large speculative casino. These bets that are going on in the markets, and I mean all the markets, aren't about gold and silver per se, although they're basically about what this derivative exposure is relative to that derivative exposure, because that's where all the money's being bet. It's bet on these paper derivative products. It's not bet in the physical market. That's why these physical markets can overtake the derivatives markets at some point, and I believe strongly that they will. The problem is that, and I get asked this, so I'll just answer my own question, is, well, why doesn't somebody just come in and make a big purchase? And the answer is that no one really wants to be the one that brings it down, that could bring it down. For example, a large nation state like China. Why doesn't China just buy all this gold and stand for delivery in December and take the markets out? Well, because they have a lot more vested interest in the paper markets than they ever do in the gold market, and they're going to continue to buy gold until they can't. And the only way to do that is to accumulate. And the way to accumulate is by a relatively small amount over a long period of time until there isn't any gold available. I mean, this is what happened in 1971 when Nixon closed the gold window. I mean, it isn't like in 71, all of a sudden one day, someone made a huge order and the next day you had to close the gold window. No. France and other nations were collecting gold, month after month, year after year, and it drained the gold pool, and all of a sudden the reality was there over time. And they just chose August 15, 1971 to admit that there was far more dollars printed than there were gold to back it. Well, take that on steroids. Take that up to 100 times the amount of gold paper claims that there are relative to the amount of physical gold that there is. And that's the situation we are in. But it isn't like a nation state like France could come in and say, I want all this gold. I mean, it could happen. And again, the China analogy is a correct one. I mean, could they buy futures and stand for delivery? Sure, they could. But that's not the way it's going to take place in my view. I think they're going to continue to accumulate until they can't. And their gold position is like anyone else's gold position that understands these markets. It's for the day that the dollar collapses, or the month or the weeks, and usually these things aren't overnight. I mean, the dollar's been collapsing since 1913, like I outlined. The problem is no one wants an anomaly. In other words, a bank run, a bank closure, derivatives exposure, the stock market folding down, some electronic failures, some non-clearing, something that takes place that's so substantial and significant, primarily in the bond market, my guess, or derivatives around the bond market or interest rates, that once that happens, you really can't put it back together. And we really got close. And we've been close a couple times. We were close with long-term capital management. Look at the movie called $1 Trillion Bet and see how close we were with that system almost coming unraveled due to long-term capital management. And we got very close, I believe, in the 2008 or 2007 crisis, where basically banks didn't trust each other. And believe me, this whole thing is a con game. It is a confidence game. And right now there's a lot of confidence in the dollar. But at some point in the future, that confidence could be displaced, and the confidence moves into an asset class that's stood the test of time for thousands of years, and that's the precious metals. And there's so little relative to how much there is in every other asset class. If you look at that pyramid, you get a feel for all of that quote-unquote money or claims on money versus how much money, meaning gold and silver, there is. And it's rather almost amusing to consider what it actually is, because it's significantly, on paper terms, basically off the charts.
All right. Well, David Morgan, we'll have to leave it with that. But once again, thank you so much for sharing your insights today. Did you want to share with the viewers where they can find you?
Sure. The YouTube channel is Silver Guru. The Twitter feed is @SilverGuru22. The website is silver-investor.com, and get on our free weekend mailing list if you want to see how we write and our thinking. And then for members, just go to the right-hand side. There's 3 levels of membership. If you have the most popular service, which is the intermediate one, you have the ability to actually write me an email directly. I don't necessarily answer them all. Sometimes I pass them off to one of my staff, but you always get an answer. And sometimes we put the answer, sometimes we put the answer in a report because we feel the question is so significant that it'll benefit all of our readers. A lot of times we'll just answer an individual directly because it's a question that basically has merit for them and them only. So that's something to bear in mind. Also, it's a 30-day money-back guarantee. I mean, if you subscribe to it and you don't really like it, just let us know. You know, you're done. You can stop. It's not a big deal. So thank you for that, Elijah. I hopefully give your listeners something to think about. Certainly, I think about these things all the time, and I'll just end with this. I'm probably more concerned about where we are in the system now than I was, let's say, at the 2008 level before the crisis. I'm not predicting that this is going to happen, you know, in any imminent way or time frame. What I'm suggesting is that the precursor to the situation financially prior to the 2008 crisis is worse today than it was at that time, and that concerns me.
This video was brought to you by ReluctantPreppers.com.